Thank you, everyone. Appreciate the opportunity to speak to you guys here at Keller Williams. The first slide, I want to make sure your point out, it might state obvious, but the IRS says that if you are an independent contractor, you are self-employed. And so the point I want to make here is that you are a business and you need to be leveraging that. And so, you know, your management team or the team there at Keller might be saying, hey, you are a business, meaning like you are in charge of your own destiny, and the more calls you make and the more activities that you do, that's how much business is going to come in for you. But I'm talking about it from a tax perspective and leveraging the tax code related to businesses that you may not be familiar with. So the way I've kind of broken out this deck is into like three main topics. One of them is maximizing deductions. The other is a mouthful, tax classification optimization. I'll explain what I mean by that. And then the third bullet point is just retirement and some niche strategies. So let me give you a little bit of background about myself. So my name is Navi, as Emily introduced, Navi Maraj. I was in the banking world prior to becoming a CPA for about 10 years, but total banking and accounting, I've been in the industries for about 14 years now. And I work for some of the larger companies like your Wells Fargo and your Chase. In my accounting days, I was working for Deloitte & Touche. Why am I mentioning this? Well, I really want you guys to know that for the 10 years that I was in banking, I was functioning as a business banker as I progressed throughout my career. And so I can very much relate to you all. What I mean by that is my book of business as a business banker had clients within it that wanted to purchase commercial real estate, right? And so not only did I sort of know about their transaction, probably perhaps before the realtor knew about the transaction, but we worked with obviously the underwriting piece of it, credit approval, but then, then they joined forces with the realtor and they signed the contract. But I also oversaw the other parts of the process. So I'm very much familiar with the fact that there's a little stick of dynamite sometimes waiting for you in the inspection process, appraisal, environmental reports, insurance, engaging title company. I've experienced all that myself. And so I understand your industry and I know what it's like to get those calls and a deal could potentially blow up and you have to salvage it. I do also run a CPA firm where I only help real estate professionals. So that's you, the agent or broker or realtor. And I'll elaborate on what services I offer towards the end of the call. So let's jump right into maximizing deductions section. Some of these you'll have heard of, others maybe not. So let's talk about some of the basic things first. Let's just quickly chat about home office real quick. I just want you to know that there's still this sort of theme out there, if you will, that this is a red flag for an audit. And that's just simply not true. If you think about where we're at in 2020 and the power of the internet and all these different technologies that we have, the IRS at this point in time expects everyone to be operating from home, especially given our current climate with COVID and all that stuff. So the point I want to make is in the event you're not taking this as a deduction, you should be. But I also see many of you taking it in what's called a simplified method, where it's basically a calculation that's just $5 per square foot of your home that you use for business. And I think that there are certain tax professionals out there that are not showing you what the regular method could look like. And I just want to express to you that the regular method allows you to deduct the business use percentage of your mortgage interest, homeowners insurance, HOA dues, condo dues. If you're not a property owner, you can still do a percentage of your rent or renter's insurance, all these different things. So if you maximize this deduction, typically I see clients getting 3 times the deduction with the regular method than they do with the simplified method. I would assume that if you're a homeowner, it should be at least $1,500, being pretty conservative for a deduction for you. Auto, I know all of you are taking this deduction, right? And I know, hey, Navi, great, I appreciate your time, but why are you telling me about the auto deduction? I've been doing this forever. I want to just emphasize that, yes, I know a lot of you are doing it. I do also know that a lot of you are out of compliance with it, right? How many of you are doing the actual log? And I don't expect you to have a handwritten log anymore, right? But at least utilize the apps available and leverage those. If you're not familiar with that, we can talk about that later. But Another point I want to make is if you've established the administrative home office, which I touched on the previous slide, then at that point and only then should you be actually deducting the mileage from when you leave your home office to your open house or to visit the brokerage or do your first real estate activity, if you will. Technically, if you don't have that administrative home office, that initial set of miles to get to appointment A, or appointment 1, let's call it, is a commuting mileage, and you're not supposed to be deducting that. And then as you would go from appointment 1 to appointment 2, then that would be deductible. But anyway, I'm just letting you know, I see a lot of clients that are not in compliance with this strategy. But each year the IRS has been adjusting this rate. And so in South Florida, we kind of drive a lot given the Tri-County area. And so, I would expect to see at least a $7,000 deduction here, given if you drove 12,000 miles. So again, home office, auto, they kind of go hand in hand in my view because of what I mentioned about establishing that administrative home office, but there are deductions that you're likely taking. Let's talk about one that you may not be taking. So I know travel is pretty light these days, but I'm talking about leveraging the tax code to work in your favor and fit in a lot of personal stuff while you're traveling for business. So on the slide here, what I have is a scenario where I'm saying, hey, you travel within the US typically for business on a Wednesday. So that's a travel day. Thursday, you conduct business. Friday, you conduct business. Saturday and Sunday are 100% personal. You're out with kids or a loved one or whatever. Monday, you conduct a little bit of business. When I say a little bit of business, I mean at least 4 hours. Tuesday, another travel day. In this example, 100% of your airfare, 100% of your lodging should be deductible, even that weekend activity. And 50% of the meals for the entire 7 days that we have up here should be deductible as well. So you just have to plan your personal travel in advance and maybe have a conversation with your tax professional to be able to leverage this as much as possible and deduct the entire thing if you can. We can go a step further. Maybe you have a spouse who is on your board of advisors if you have an LLC, or children that are involved in the business because they maybe handle your social media or some other stuff. So maybe we can tack on their airfare as well. We just have to strategize and do that in the proper way. Hiring children. So, this is a big one that I don't think a lot of people are doing. And I'm not saying we're going to hire your children just for the heck of it and just pay them money just because. What I'm saying here with this strategy is if you execute this properly, you can get up to a $12,000 deduction. I'm rounding. It's technically $12,400 in this year. And your minor children can receive that income with no tax paid by you and no tax paid by them. And I'm not saying to do anything unethical here. We want to make sure, if you have a child who's maybe between the ages of 7 and 17, start teaching them about earning their money. So maybe when they're that young, on the 7-year-old type size scale of things, they're cleaning your home office a little bit or doing minor things, helping you stuff some envelopes or participating with mailers or something. As they get older, maybe they're helping you handle your social media accounts, or they're handing out things at an open house or what have you. Be creative with it. There's many things that we can do to get them involved. But the point is this. The point is stop paying tax on your business earnings and then paying your kids for their various expenses, whether that be technology like the latest smartphone or laptop or tuition or whatever it is, and let them earn that money and then use that money that they've earned to pay for those items, right? So I'm saying, hey, if you incur I'm sure your child costs you more than 10 grand a year, but if that's how much it is, then, get them involved in the business, take the deduction, and then have them earn that money and pay for those same expenses and get a deduction out of it. We'll talk about the advanced strategy one-on-one, but just high level, that's what I'm talking about here. So again, this could be a $12,000 deduction per child. So if you're not keeping track, let's just summarize a couple of things. These are 4 basic strategies, and I'm saying if you add them all up, we're talking about $21,000 worth of deductions. And so what does that mean in terms of dollars and cents in your pocket? Well, I can't answer that question. Each one of you depends on your tax bracket. And I say marginal tax bracket here. What I mean by that is your last dollar of income, how much did the IRS tax it at? And so for most of you, bare minimum, it's going to be 12%. But for a lot of you, it's going to be in that 22, 24, 32, maybe 37% tax bracket. So you can see how the savings add up. So at a minimum, this should be a $2,500 legit tax savings to you, not a deduction, the actual tax savings, or, closer to $6,800 in tax savings to you if you, deploy these strategies and you do it correctly. So that brings us to, and there's other, deductions we can do too. These are just ones that, two that you're probably doing now, but maybe not properly. And then two that I think we can leverage a little bit more to save you additional dollars. Again, this next one, like I said, it's a mouthful, but tax classification optimization. So what do I mean by this? I know there's going to be controversy when I say this, but let's talk about the PA for a moment. So in your industry, especially here in South Florida, we hear this PA, the Professional Association. Many of you has been misinformed about this designation. It's almost kind of drilled into your head from day one that this is what you should set up on when you first start. And I'm here to tell you that that's not the case. Now, if you're a mature realtor, don't freak out. It's probably fine for you, but just hear me out on what I'm saying here. Generally, if your net income is less than $40,000, you probably shouldn't be a PA. So let me define net income for you. By that, I mean, let's say you have $55,000 in gross commission. So that's, your 1099 at the end of the year has $55,000 on it. And you're maximizing the deductions as much as you can. So you have $15,000 of deductions and you're left over with $40,000. I'm saying if your net income is less than that 40, you probably shouldn't be a PA. Why? Why? Because the PA forces you to be taxed as what's called an S corporation when you're not ready for it. What do I mean by you're not ready for it? It's because when you sort of force yourself into this S corporation, and I'm going to visualize this for you in a second on the next slide, but when you force yourself into this S corporation, your tax preparer has to prepare a separate set of tax documents, different than your personal taxes, so your individual tax return. And they're going to charge you a fee to do that. And any competent accountant that I know is going to charge you a bare minimum of probably $400 to $500, and as much as $800 to $1,200 if you're like on the extreme end. But those are tax prep fees, additional tax prep fees that you don't need to incur. And you're likely out of compliance because the S corporation, the IRS wants you to take what's called a reasonable salary. And in order to do so, you're probably going to engage a payroll company. So you'll incur fees that, tax prep fees that you shouldn't be. And number two, likely you'll be out of compliance because you won't engage that payroll company and you won't pay yourself a salary at all. So let me elaborate on this because I know it's somewhat controversial in the industry. So we can go crazy with this. I'll try to explain it simply. So I want you to understand that when you form a business, or in your case, the day you become a realtor, you're a business, right? And so if you do nothing, you'll be a sole proprietorship. Now, technically, a sole proprietorship is not a legal entity type, but I'm to explain this better and to help you visualize it, I'm calling it a legal entity type. So you're a sole proprietorship. Alternatively, you could create an LLC or a PLLC. PLLCs are common in Florida and about half of the states out there across the US. So PLLC just means Professional Limited Liability Company, all right? That's what the P stands for in front of the LLC. And basically when you have a license with the state, specifically in Florida, if you're licensed with the state, such as myself, I'm a CPA or a contractor, or you as the real estate agent, you should be forming a PLLC, not an LLC. But if you've already formed the LLC, it's kind of water under the bridge, it's fine. The other entity type is the C corporation. And by C corporation, I mean, your Inc., if you will. But again, you guys form PAs, professional associations, because you have a license with the state. The state says you should be forming a PA. I know we're talking South Florida as the audience here, but in case I replay this as a webinar elsewhere, your state might say professional corporation. So you might have a PC, or your state might not have any of those rules and you'll just have a corp or an Inc. or what have you. Anyway, point I want to make is these are the typical entity types I see realtors establish. Now, how are they treated from a tax perspective? So there are different tax classifications. So you could be taxed as a sole proprietorship. You can be taxed as an S, as in Sam Corporation, or you could be taxed as a C Corporation. So what these blue lines indicate is the default tax classification for these legal entities, if you will. So if you're a sole proprietor, which means you do nothing, you just operate your real estate business, you get a 1099, it goes on what's called a Schedule C on your individual tax return, you'll be taxed as a sole proprietorship, right? That's what happens by default. If you were to form a single member LLC or PLLC, by default, you'll be taxed in the same exact manner. You'll be taxed as a sole proprietorship. But when you form that PA, what happens by default? As you can see here, by default, you're going to be taxed as a C corporation. And a C corporation is subject to what's called double taxation. That means that the profits of the business are going to pay tax. And then again, when you as the pretty much majority shareholder, you own 100% of the business, you will pay tax again when you distribute earnings to you in the way of dividends. I know some of that's accounting language, but hopefully I explained it in a way that sort of makes sense so far. Now, what do these red arrows indicate? These red arrows indicate an option, an election is what it's called. So you can elect to have your PLLC taxed as an S corporation, and you can have your PA taxed as an S corporation. So why am I talking about this? Why am I bringing this up? I'm bringing this up because you can see that when you form a PA, you immediately are going to be subject to double tax, and you're like, hey, I don't want to do that, right? No one wants to do that. So you'll elect an S corporation status right away. And I mentioned on the previous slide why you would not want to do that, and that was related to having $40,000, you're not making $40,000 in net profit. But look at what the LLC or PLLC does for you. The PLLC gives you flexibility. It says, hey, before I make that mark of $40,000 in income, I can still establish a PLLC, still be taxed as a sole proprietorship. And then when I'm ready, whether that be this year or next year or the year after, I can sort of flip that switch and be taxed as an S corporation. So I get the best of both worlds. I could be taxed as a sole proprietorship while I'm sort of ready for that, and then activate the S corporation when I'm ready for the S corporation status. And you can see why the PA makes you an S corporation prematurely. So, okay, I've talked about, by now you're probably thinking, okay, you made it sound like I probably should be an S corporation at some time. So let's look at this kind of quick case study real quick. So the facts of this case study are like as follows. So John receives a 1099 at the end of the year indicating he earned $100,000 in gross commissions. So he had tax deductible expenses of, let's say, $20,000, which resulted in net income of $80,000. How much does John owe in self-employment taxes as a sole proprietor versus an S corporation? So let's look at this like piecemeal. So as a sole proprietor, you earned $100,000. So your commissions were $100,000. That's what your 1099 is going to get. You're going to receive from Keller at the end of the year. You have expenses of $20,000. If you work with someone like myself, your expenses will probably be a little bit higher than that, but just keeping it simple, $20,000. So that means your net income is $80,000. So I don't want to get too accounting language but basically this is a strategies for self-employment tax. So if you get taxed in this way, the self-employment tax is 15.3% of your net income. So 80,000 times 15.3% is $12,240. That's how much self-employment tax you will pay. You're still going to pay federal income tax on the 80,000. We're talking specifically self-employment tax right now. What happens when you're an S-Corp? Well, if you're an S-Corp, you still made $100,000, right? You didn't make any more money just because you became an S-Corp. You still had the same expenses. So you still have net income of 80. Well, what happens? Now we can sort of divvy up that net income and put it in two different buckets. One bucket, we're going to call it a salary. So believe it or not, you'll be an employee of your S corporation. You'll get a paycheck again. And for the purposes of this case study, I'm going to say 40% of your profit, 40% of your net income, we're going to take as a salary. And the remainder, we're going to take as what I refer to as a draw. So what happens? Your salary is subject to self-employment taxes, just as it was over here, but your distribution, your draw, is not. So you don't pay self-employment taxes on the draw portion. So in this example, John would save over $7,000 in taxes, specifically self-employment taxes, by being set up properly as an S corporation, okay? So that's how powerful this strategy can be. These are, 100% legit tax savings that you just need to talk to someone who knows how it all works and how to make it, make sure it's right for you. So public service announcement, and Emily might appreciate this. Please don't navigate this on your own. I know the intention. The intention is obviously a great one. You want to save money. You don't want to do the wrong thing, or so you want to, and so you'll watch a bunch of YouTube videos, or you might go to the top performer in your office and they're like, oh yeah, I got a PA, that's what you need too. There are legal and tax implications when you form an entity. And there are many parties involved. We've got the Florida Division of Corporations, the IRS, the Florida DBPR, your bank, your financial institution, your brokerage, all of these, myself, we all have sort of rules. We all are looking out. Well, I'm looking out for you. And we all want to make sure that when you set this up, it's all done properly. I don't want you to set it up on your own and then your bank says, hey, you made this mistake, go amend your documents, and then you're going to pay fees to the state again. Or I don't want you to set this up on your own and then your brokerage says, hey, that's great that you formed this entity, but we can't pay you this way because I can only pay you the way your license is with the state. And each state is different. I'm speaking about Florida at the moment for this call, but I know the rules in Florida quite well. And unfortunately, maybe you know them quite well at this point because you learned them sort of the hard way. But I've seen it countless times. I mean, it doesn't have to be me, but I've navigated this enough times to where I know how all 5 of these parties work. And so just, it's not meant to be an infomercial for myself, but just pay someone who understands all of these different dynamics and just get it done properly ahead of time. Because what will happen is if you do it on your own, you'll probably end up paying the same amount, but you'll just make a few mistakes along the way and have to pay fees to get it done anyway. All right, retirement, some NIT strategies. By the way, guys, I know I'm going kind of fast because the point of this presentation is just to hit the high points, making sure you know that these strategies are out here. I'm not here to teach you the strategies on this call. I just want to make sure you're leveraging all these things, or if some of these things, pique your interest, we can schedule a call later. So for retirement, I'm not going to go into all the little details here. What I want you to know is you have options, right? You're not limited to the IRA where you can just save $6 grand or $7 grand a year. There's the SEP IRA, where it's probably best if you want to save $7,000 to $15,000. And there's a solo 401k, which I don't usually recommend this from a tax perspective, but you can go up to $50,000 in a retirement account in a given year when you're a business owner. Something that you see noted below, you don't have to invest these funds in traditional like stocks or cash, just have it sitting there in cash. You can do what's called self-direct. You can actually self-direct all of these accounts, which means you could actually invest in real estate property within your solo 401k if you wanted to, or not that I'm advocating it, but cryptocurrency or another business or other things. I'm letting you know that you have the ability to self-direct these things. All right, HSA, health savings account. The point I want to make with this is that it's the only account that I can really think of that the IRS has set up where you get a deduction when you contribute money to it. Your money grows tax-free. And when you take the money out for medical reasons, it's also tax-free. So it's the only one that sort of checks all these boxes to get tax-free income. There are some, little bullet points I wrote down below, but you know, let me just blow your mind for a quick second. If you leverage this tool, if you will, there are people out there that will contribute as much as possible to an HSA, not use the funds for medical expenses. They just accumulate money in this account. Then they might self-direct the HSA and actually, believe it or not, purchase real estate within the HSA. I'm not talking South Florida real estate market here, okay? It's hard to do that, but I'm saying in some areas you can still find a $50,000 condo or something, right? But anyway, they purchase real estate within their HSA. That HSA kicks off, or that real estate within the HSA kicks off monthly rental income, and that rental income is now paying for all their healthcare as they're in retirement. So I know that's a lot, and that's an advanced strategy, but I'm just letting you know there's tools out there that you can leverage to take advantage of. Another advanced strategy is something called the Augusta rule. Basically what this is when you're making enough income, and let's say you're actually, you know, you have a nice home where you can actually invite clients to this space or have meetings or conduct annual meetings or quarterly meetings with your board of advisors, who may very well be your spouse or other, I would call them friends, but friends that you trust and you actually want them to be involved in your business. You know, and there's ways to incorporate this where you can technically rent your home to your corporation, get a deduction for it, and not get the income tax on your individual return. The picture of the golf thing here, you're like, hey, did you make a mistake? No, I didn't. This Augusta rule comes from tax code that's written due to you know, the Masters and the Championship in Augusta, and the community around there renting out their home for a few weeks out of the year for people that travel to this golf event. All right, and some of you have investment real estate. All right, so what I want to let you know here that is basically, if your accountant is checking the proper boxes, which I can tell you I've seen a lot of times where they're not, but real estate professionals can deduct passive activity losses against earned income from their self-employed business and your spouse's W-2 job. Now that's a lot of accounting and tax language, so let me kind of break that down a little bit. What I'm telling you is real estate professional is also actually a tax word, if you will. So I am not a real estate professional, I'm a CPA. And you might think that I have the knowledge to leverage everything possible. It's not, knowledge is probably not the right word, but even I, as a CPA, cannot take advantage of things that you can as what the IRS calls a real estate professional, which just means that you're involved in real estate as your business. That's what you do. Anyway, what I'm saying is, on paper, your investment property may be producing a loss by the time you deduct all these laundry list item things I have in here, like depreciation and mortgage interest and property taxes and all that stuff. So on paper, you have a loss, even though you have cash flow coming into your bank account each month. And what I'm saying is, for a lot of us, that loss gets sort of stored in a bucket and I can't use it until I sell that property. But for you, that loss can actually offset either W-2 income from you operating as a real estate professional or your spouse's W-2 income. And that's not the case for people that are not real estate professionals. So that's just a point I want to make here, is just make sure you're taking all these deductions if you have investment property. And if that investment property is producing a loss for you, make sure that you're actually offsetting income with these losses and not just carrying them forward because your tax preparer is not knowledgeable and is not treating you as what's called a real estate professional from a tax perspective. All right, so now I just want to tell you like a little bit more about who I am, how I help my clients, and then we can open up for questions if we have time. I haven't been keeping track of time. So
you're good. You have the entire hour, my friend. So you have 20 more minutes.
I got the whole hour. All right.
You got the whole hour. You're gifted an hour.
I won't take an hour of your time. If you guys have questions at the end, we can field some of them, or we might have to schedule an appointment or what have you. So I help my clients in 3 different ways. On the left, you see tax planning. So tax planning looks very similar to what we're doing now. I would go through a deck with you one-on-one. We would go through the deck. I would ask you questions. Hey, what are you doing now? What other things can you be doing? And find out what sort of strategies you're not aware of and what you could be taking advantage of. And at the end of that call, we'll come up with a number that says maybe you've been overpaying by, this is a real world example, $9,000 in taxes every year, year after year, because you didn't know about this S-Corp strategy thing. So, what would happen is if you decide to do business with me, the tax planning call is free. If you decide to do business with me and move forward, yes, would I charge you a tax planning fee? Of course. However, I would put together a tax plan for you. I would deliver that plan to you. And then where the true value add comes from is I would spend, a good 6 months to a year helping you implement those strategies and showing you, hey, okay, now we need to implement strategy A, strategy B, strategy C, and show you how to do those things throughout the year so that you actually realize that $9,000 in tax savings that we spoke about on the tax planning call. That's where the actual value comes from. So tax planning, that's one way I help my clients. Another way is what I refer to as outsourced CFO services. In a nutshell, what this means is, if you're closing enough deals, I really shouldn't put a number on this, but if it's like, let's say 2 deals a month or more on average, chances are you're too busy to deal with your accounting and bookkeeping and tax. And so you outsource that to me. I'll be handling all of your bookkeeping for you. Every single transaction that comes through your business account will be put in the most tax advantage sort of business expense for you. I'll be helping you with some of those things I mentioned on the previous slides, such as optimizing your payroll, paying you the proper salary, telling you how much you can distribute otherwise, telling you how much you should probably be paying in quarterly taxes. I know a lot of you are not paying quarterly taxes. You just pay it all at the end of the year and pay those late fees. I'll be there as a resource to answering tax and accounting questions throughout the year. Anyway, you get the idea. You outsource that to me so that you can focus on that next real estate transaction, because I know you guys are fielding a lot of calls right now. You don't have time to be doing this stuff, all right? So that's what sort of CFO services are. Tax prep is probably what you're most familiar with. Tax prep is where, hey, once a year, I visit my tax accountant, I send them my stuff, they prepare my return, they send me their bill and the IRS bill, which is high, right? And unfortunately, if your tax professional only offers a tax prep service, chances are you're overpaying in tax because they just don't have the time to do any tax planning or anything like that when they're preparing your return. Or even if they did have the time, it's too late, because typically you're preparing your return in, let's say, 2021, March of 2021, but all the activity occurred in 2020. And so it's too late to implement some of these strategies at that point. So those are the 3 ways that I typically help my clients, and usually somehow involved in the tax planning or the CFO services is me helping you set up your entity if that's what you need assistance with. So with that said, again, just want to say, thank you. I appreciate your time. I know how busy it is right now in the market. I hope you are leveraging that as well as maybe I opened up your eyes to leveraging some parts of the tax code that previously you were not. Here's my contact information. There's no excuse to not be able to get a hold of me because I'm available in so many ways. The best way, if you want to contact me, is probably using my online calendar. And so you can kind of jot down this link, or perhaps Emily already has done so, but feel free to share this deck with the team. Or you have my phone number there, my email, and my website. If you go to my website, you'll see my online calendar embedded within my website. So you have an option of just setting up an intro call. We'll get to know each other a little bit better. You'll tell me about yourself and see, what things we can do, or answer any questions that you have, or see if we set up one of those tax planning calls to see just how much we can possibly save you in tax. So with that said, I'll sort of leave this slide up, but if you have questions, I'm happy to field a few for you. So don't.
Question: what is something that you recommend for realtors not to do? Like a common thing that gets them in trouble that you can, kind of buyer beware.
Yeah.
you can recommend to the realtors, like, don't do this.
I touched on it a moment ago. one would be setting up your entity without understanding all those parties involved, and to make sure that you don't set up an entity that unfortunately a brokerage can't pay you as. And so now you've got an entity set up that's, I don't want to call it useless, but like there's so many extra steps you have to take when that occurs. So that's a big one if you're kind of new. If you're a veteran, I would say make sure that you are taking a reasonable salary. I see a lot of people who are taxed as an S corporation, and as I said, the IRS says you need to take what's called, quote unquote, a reasonable salary, and a lot of realtors are taking zero. They don't even know they need to be taking a salary, so they distribute. And some of this is their tax professional not informing them this either. They distribute all the earnings to them without taking any as a salary and not paying self-employment tax. By the way, when I say self-employment tax, that's Social Security and Medicare taxes. And that's a huge red flag and ripe for an IRS audit. So that would be a big no-no. And there are many things. I mean, the third thing that comes to mind is when you have an S corporation, how you deduct what I refer to as hybrid expenses matters. And so you should have something called an accountable plan. So let me give you an example of this. You have your business expenses, which should be run through your business account. So for an example, that would be like your MLS, fees or marketing and advertising fees. That's a 100% business expense. Then you have your personal expenses that are 100% personal in nature, such as buying furniture for your home, or going out on a date, or any other 100% personal expense. Then you have this sort of in-between bucket when you're an S-Corp, and I should say tax as an S-Corp, where your cell phone, maybe your home internet, your home office, your vehicle, those are usually expenses that are titled or so in the name of your business, and that get billed to you personally, but a percentage of those are going to be write-offs for a business expense. And when you're an S corporation, you need to navigate that properly and not just have it come out of your business account. It's done through something called an accountable plan. It's beyond the scope of this conversation, but know that you need to be doing that properly, or else you technically could get in trouble if you get an audit. So hopefully I didn't overwhelm you there, but that's another thing that I see where people aren't treating, as I said, those hybrid expenses properly and not deducting them in the right manner.
That's awesome. Now the last, question or recommendation is, and I commonly see this as the MCA of the office, realtors maybe not planning ahead of time. So, what are some of the benefits that you can give realtors in kind of doing this, as they go and managing their finances properly? So come tax time, what are some things that you can say around that?
Yeah, I would say that it's a combination of things, but with the tax planning, here's the misconception. The misconception is that I can save all the amount of money I need to in taxes when it's time to prepare my tax return. And that is very, very wrong and not true at all. What you need to be doing is, when it seems like you don't have time at all, that's when you should be doing it. Because what I mean by that is, when you're at your busiest is when you're making the most income, and when you should be having conversations with your tax professional that understands real estate, understands your niche, and can put things in place as they are occurring. Many people have this misconception that I only pay taxes once a year because they file their tax return once a year, and if they owe, that's when they pay them. But in reality, you're supposed to be making quarterly tax payments throughout the year. So if I set up a tax planning or a tax plan for you or anyone else, those are tax savings that you're realizing throughout the year, not at the end of the year when we file your tax return. And by that, I mean, you're going to be sending less money to the IRS on a quarterly basis because we're doing the planning throughout the year. So that's one thing I will mention. That's like, tax prep and tax planning are two different things. And tax planning is the most crucial thing when it comes to saving money in taxes. A second thing is, with that outsourced CFO services that I offer, something I totally failed to mention is that you're going to get a profit and loss statement from me each month. And so each month I'll be able to show you, hey, here's how much revenue you brought in. Here's where your expenses went. Hey, I think this is quite high compared to all my other real estate professional clients. Why is that? Did you start a new marketing campaign or something going on here? And with that, you can actually see like how much profit your business is making, or perhaps not making. And maybe that tells you, hey, I need to tweak my activities and build up a greater pipeline or make more calls, because it seems as though if I'm going to, make this my career, then I need to be at X dollars per X transactions per year, or what have you. So treating your business like a business. Again, I kind of opened up the call saying, your management team or your team leader might say that from the perspective of getting the activity or doing the activity to get those sales. I'm saying it from that perspective too, but also treating your business as a business from a financial and accounting perspective, so you can actually see, okay, like I'm running a legit business here. It's producing $10,000 in profit for me a month, and I'm maximizing everything I can to save money in taxes. So I guess those are my big sort of take two big things. Tax planning is more important than tax prep. Shouldn't say more important, but it's more valuable than tax prep. You will save money throughout the year. Don't think of it as a only tax time event. And also that outsourced CFO services is huge, so that you could see on a month-to-month basis how your business is doing. I will give you a real world example. Literally yesterday, I had a call with a client in Texas who's been swamped. He deals with new construction. He's kind of in this niche in Texas. And I said, hey, do you know what your revenue is so far? He had no idea. He knew that he was about to close his 50th transaction, and well, you're approaching 150,000 in revenue. He had no idea. He had no clue. And I had to even tell him, hey, well, these are what your expenses are, and so forth and so on. Now, he had no idea because he's been super busy, but I've been doing his bookkeeping. So we went through his financials, and I showed it to him, and he was shocked, and he was excited. He was obviously happy. But that's just a legitimate example of where just yesterday that happened to me. And I can probably speak for most of you, and this is not me bashing you. I'm just saying, I don't think that your tax professional, or if you're doing this on your own, that you're in a position to be able to say, I know exactly how much income I have, what my expenses are, how much I spend in advertising and marketing spend, how much was, MLS fees, how much was this, and this, and be able to gauge if something is too high or out of whack. So perhaps I rambled there, but those are the two big things that I see.
I love that. Perfect. Well, thank you, Navi. This has been so great. And you guys, I will send you an email with this presentation, and we will post this momentarily on our social media pages if you want to go back and review any points that Navi talked about. And for sure, set up a consultation with him, and have at least an initial discussion to see if there's anything that you guys can do for your business to help kind of take it to the next level with your finances. Okay.
Well, thank you again, Emily and Keller Williams, for setting this up. And I would say, please don't be shy. These intro calls and these tax planning calls are free. All you're going to learn from it is perhaps you're doing everything either correctly or not, and we need to fix some things. So don't hesitate to reach out. I'm happy to help.
Perfect. Thank you, guys. Have a great afternoon. Thanks, Navi, once again.
You're welcome. Thanks, everyone.